Hello, and welcome to another edition of Wealth Management Insights. I'm Lisa Shalett, Chief Investment Officer for Wealth Management, and today is Monday, January 26th, and I'm recording this from my snowed-in location in Ridgefield, Connecticut. Stock market leadership has been shifting away from technology companies and the Magnificent Seven as investors embrace the call for a broadening in corporate earnings growth. Much of this move has made sense to us. For example, appetite has surged for commodities, for cyclicals, and for financial services companies. However, one development continues to confound us: the sharp rise in small cap stocks, and the lowest quality small caps at that. Since the end of October, the S&P 500 large cap benchmark is up only about 1.1%, while the small cap Russell 2000 index has gained 7.7%. And the unprofitable component of the Russell 2000 is up significantly more at 12.2%. We understand that small caps are often part of the pro-growth Fed easing playbook, and that growth expectations are high this year with so much stimulus expected from the Fed, the new tax law, deregulation, and of course the Gen AI CapEx boom. But this is not a typical early recovery growth cycle. Nominal GDP growth has already been running at more than 5% and closer to 7% in the past few quarters. Although the small cap Russell 2000 index is overweight some of our preferred sectors like financials, healthcare, and industrials, we remain skeptical of the cohort overall for a few reasons. The first is the high proportion of unprofitable public small cap companies. Today, in a red-hot economy, a full 43% of the companies in the Russell 2000 index are not profitable. We believe adverse selection has played a part in this as the private equity business has surged. Second, among small caps that are making money, earnings expectations are eye-popping. For the small cap S&P 600 index, earnings growth is expected to catapult from the current range of 4 to 5% to something between 25 and 30% based on estimates published by Bloomberg. That seems unattainable to us, especially when policy uncertainty is still high, labor availability is tentative, and the importance of scale in technology is only growing. Finally, small caps are now materially overbought in our view, with their strength versus large cap equities and the Mag 7 at an extreme. In fact, in the first 14 trading days of 2026, the Russell 2000 outperformed the S&P 500 every day, one of its longest streaks in the past 30 years. Undoubtedly, small cap investors have had a tough 5 years. From 2021 through 2025, annual returns were less than half those of the S&P 500, and the valuation difference between small and large caps was extreme. But since investors began taking more risks after Liberation Day last April, the Russell 2000 has climbed to new highs. And today, the investment rationale for them comes down to a belief in economic reacceleration. Ultimately, we think that this has been a trade with gains concentrated in the lowest quality names, and that will create disappointment. Thus, now may be an excellent time to take profits. Consider preparing for new equity index leadership and for better liquidity opportunities in private markets. Also considering rebalancing for maximum strategic diversification and avoiding single name concentration. We favor broadening to Gen AI productivity beneficiaries in financials, healthcare, and energy, and adding to rest of world equities with a focus on emerging markets. Finally, plan for 2026 vintage deployments in venture capital and growth equity, as well as private commercial real estate. As always, thank you for listening, and for more information on portfolio strategies and financial planning, please reach out to your Morgan Stanley financial advisor.